Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Tired of stories about other people's success? We can help you change your life, determine your time freedom point, and join us on the journey to financial success. Let's go. Hello and welcome to another episode of the Ideal Investor Show, where we bring you great guests and great topics on how we can invest, how we can develop passive income, how we can get to the time freedom point so we get the choice to decide what we want to do with our time and not have to be dependent on an income that comes from a job. So today we want to talk to the CEO of Unlimited. We're very proud and happy that we were able, Bob, to convince you to come. So Bob, Elliot, welcome to the show.
Thank you so much for having me. I'm excited to be here.
Yeah, wonderful. And thanks for making the time. So before we dive into what Unlimited does and how it all works and so forth, maybe you can tell us a little bit of the journey of how you ended up being the CEO of this company.
Yeah. I've been a systematic investor for my professional career for over the course of a couple decades. I actually started my career at Bridgewater Associates, which is either the first or second largest hedge fund these days, helping grow it from being sort of a challenger hedge fund, pursuing the concepts of systematizing macroeconomic understanding, to being the incumbent that it is. And while I was there, did a whole bunch of different things, including serving on the investment committee, as well as running Ray Dalio's personal investment research team for more than a decade. That my time there, and actually after I left Bridgewater, I ran a systematic venture fund that was $125 million in size, also trying to bring sort of those systematic approaches to private markets investing, where there isn't a lot of systematic approaches, particularly in the venture space. And what I mean by that is just using big data and using decision rules to help guide investment decision making. And I think my time at Bridgewater, as well as my time in the private side of 2 and 20, increasingly I recognize that 2 and 20 businesses are not that great for the investor, and they're pretty good for the manager, right? And the reason why that is the 2 and 20 businesses typically generate pretty good returns, but they also typically charge pretty high fees, which means investors are often not that much better off than they would be on their own. And so that got me to thinking about whether there was a way to bring my wealth of experience in this space, paired with sort of modern approaches, modern technologies, to build replications of what 2 and 20 managers are doing, and package those and make them accessible in a retail friendly form. So for instance, in the form of an ETF, so that any investor of any size could get access to these sorts of strategies. And that's what Unlimited is all about. We founded Unlimited. Basic idea is diversified, low cost, tax efficient 2 and 20 index funds, at a much lower management fee and a much more tax efficient structure than typical LP positions. So we've been doing that for about 18 months, and they're really excited to be here.
Yeah, that's really cool. And thank you for being able to put that together so concise. I always struggle when somebody says, tell me what, and then I go on blabbering forever. That was very good, Bob. Maybe, people in our audience may not necessarily be that familiar with the 2 and 20 management or investing or stuff. Can you expand a little bit what that means?
Yeah, 2 and 20 is a little bit of a quick description of a whole suite of different styles of investment products that typically charge a 2% management fee as well as 20% performance fees. That's why they're called 2 and 20. And that's meant to distinguish them from things like ETFs or mutual funds, which typically have much lower fee structures and often don't charge carry. And so in that 2 and 20 range, there's actually quite a diverse set of different strategies and investment styles. There's everything from, very liquid, fast trading hedge funds, all the way to extremely illiquid private equity, private credit, and venture capital funds. But really what they all have in common is that they're typically structured in some sort of limited partnership or fund structure. They're also typically only available to investors with very high net worths who meet accreditation or qualification standards in the US. and they're typically very high fee. Typically, the average 2 and 20 business charges something like 5 to 6% annually in terms of fees. And so that sort of defines all of them. And it's really where a lot of the most sophisticated asset management strategies in the world exist in these structures today. And really, most investors are locked out of those structures unless they're essentially institutional investors.
Okay, yeah, thank you for that explanation. Just very quick, let's just say, we're not going to the extreme Vanguard example, but maybe something like a Fidelity or so that is somewhere in the 1 to 2% fee range. Why would people be willing to pay 5 or 6%?
Well, I think there's a number of different reasons. One of the common reasons is that you otherwise wouldn't have access to these returns, right? And so something like a private equity portfolio or a venture capital portfolio, without these sort of fund structures, there really are few alternatives to gain access to those types of returns. And so you might be willing to pay higher fees in order to get those returns. And I think one of the challenges that many investors have is often what you'll see is sort of the top 20% of these funds do quite well, can deliver, 10%, 12% net of fees returns or higher. The problem is the sort of 2 and 20 fee structure applies to all of them. And so a lot of what we're focused on is saying, well, in general, the strategies are pretty good. Even the average strategy is pretty good. So like the index is pretty good. The problem is the index, once you take the 2 and 20 fees off of it, is generally not that good. And so instead of going and trying to chase to see if you can find the very top performers, which is very challenging, very, very challenging to find the top performers reliably over time. Most people who can identify them, it's luck rather than skill, because there isn't return persistence. They don't continue to have elevated good returns over time or above what would happen if it was just mere luck. And so instead, it's better to invest in a diversified portfolio of these managers because overall they're pretty good. It's just the problem is their fees are too high and their structures are tax inefficient. So if you can lower the fees and you can make the taxes meaningfully less than they would be in an LP structure, you actually have an investment where you have a lot more certainty about what the outcome is likely to be, and one that has a lot more benefit in terms of the net of fees, net of taxes outcome, which frankly is the only thing that investors really care about, is the net of fees, net of taxes outcome.
Yeah, I agree. I mean, this is probably the first part of what you were just explaining. I'm saying this slightly facetious, but only really, really, really slightly is probably the reason why when you look at the people that are being invited for the most part as so-called analyst experts on financial shows and YouTube channels and stuff like that, I'm one of these people. If I hear something that I find somewhat outlandish or so forth, I look up the person, that so-called expert analyst, and then I find, ranked 4,325 out of 7,500. I'm like, why is this person supposedly an expert when he is definitely in the lower third of all the people and who are investing? And then you find out, oh yeah, they had once in their life, in the last 30 years of their lifetime, they had once said something that happened to become true. I put that like a blind chicken finds a corn every once in a while, right?
That's right. And I think the thing that's interesting is that actually the collective wisdom of all of those managers is actually pretty good. And it makes sense. Like you would expect, in the hedge fund space, you have, many funds, thousands of funds investing tens of billions of dollars trying to generate differentiated returns, right? A particular person may or may not be good. But actually, if you look at it, the collective wisdom of that crowd is actually meaningfully better over time and meaningfully more reliably better over time than index investing. And so that's kind of the idea is draw on the wisdom of the crowd. Don't focus too much on any individual manager because whatever, there's lots of randomness in the world in terms of whether a manager gets something right or wrong.
No, I'm with you when you compare to the index. On the other hand, I have to say, when I compare to somebody who gains, like this is what we do. I mean, this is also before we started recording, I said, our investing suggestions, not advice, not a lawyer, not CPA, nothing, right? I have to say this. But when we're working with our clients, we're basically suggesting to follow what I'm doing from a portfolio design. And that is basically 70% in real estate, and then the other 30% in different categories to diversify. Well, what's interesting is even in these diversified categories, it's one thing to say the combined wisdom is better than the index, but I think that's not really that much of a measure, because when you look at what am I looking at that I really either am very interested in or I want to put in the effort to really understand it, which is kind of the expectation, at least I used to have, what an analyst should do, right? If that's really their job, like a sector analyst for the auto industry, right? And you listen to what they're actually saying, and then you look at how the portfolio of auto shares or stocks and individual companies actually perform, and I come constantly to the conclusion, are they actually reading anything that these companies are bringing out? Are they actually looking at the dynamics that are happening in the economy, both domestically and internationally and stuff? Or is it basically just gut feeling, and every once in a while they're lucky and are right? Because if somebody like in our community, we are obviously long-term investors. When you look at all these people, I always say, these guys are all sitting in a casino. I only need to be convinced that my investment, like in a real estate property or something else, like in a certain stock, is right for the right reasons for me to be convinced of it. And then just constantly confirm that that is still the case, that the answers to the questions that I asked myself in the beginning are still yes, then I'm good to go. I don't have to do anything more. And they're in and out, and then, they find out this, I don't want to go on a rant. But I find it comical in some cases now, like if you take NVIDIA or Tesla or Palantir or stuff like that, where the so-called analysts adjust their price targets after the fact. And when the thing has gone up 30%, right, or 50%, or like in Palantir's case, almost 100%, then they say, okay, I go from $10 to $18 when it's already at 20. Oh, great, you're really a wonderful analyst. With Tesla, right? Like, so they were at 100. They got to 200, then they said we raise our target to 300. No real reason given. Then they go to 300, and then they go down to 200, and you say, okay, you guys don't know anything more than me just buying the thing and holding it, right?
Well, I think that is a particularly true point when it comes to sell side individual equity research, which is like, they're sort of the only people later to the party are like the ratings agencies. Well,
and I mean,
they're like closing the door behind themselves, and the rating, the guy from Moody's is trying to open the door to be like, oh no, there's a credit problem. It's like 2010. Like, oh my God, there's a credit problem in subprime. So like I agree with you in terms of particularly the sell side research. I think part of what is interesting is that when you come really to the buy side, when you come to places like hedge funds, like a lot of times they're not telling you what they're doing, right? Like the good funds, like there's lots of good funds that are out there that you've never heard of, that won't talk to you, that don't give quotes in the Wall Street Journal. What they're doing is what they frankly should be doing as fiduciaries, which is just sitting down and every day putting money on the line and investing their money over and over and over again. And I think part of what our view is, in having been sort of in the inside and seen that, is that that is, if you can understand what they're doing, that's definitely a lot better than sell side research, a lot better than analyst research. It's because those are people who actually have the money on the line, and if it's not working, they're getting fired in one way or another.
Yeah, so I agree. I totally agree with that. Although one thing I disagree with, and I hope you don't mind, I think you would actually.
You can disagree with me all you want. No worries.
I'm just saying on the wording. I really at the point now where I believe that people in the hedge funds are actually doing research by what it really means to do research, whereas a lot of the traders or the figureheads that come as so-called experts to CNBS are actually not really doing research. They do speculations. They're speculating on something and then draping some kind of reasoning around their speculation. And sometimes they're right, most of the time they're wrong, and then they have to adjust their speculation. So for me, research is something that you need to do something to deserve that moniker research. And I believe you're right that the people in the hedge funds, instead of being out there advertising tons of stuff, they're really spending time to try to understand. The
just
dynamic, I think part of the dynamic is when you really do this for people that have a lot of money, you have to also be a little bit more able to explain why you did what you did. You know, like
no, that's totally right. That's totally right.
Retail investor has very little opportunity to ever get to the analyst who actually published the report that claims that the thing is going to gain 30% in the next 3 months or something like that. Now, I want to transition a little bit because I was quite fascinated on your website to see that you do something like machine learning. I believe I know what it is, but I would be remiss to not ask you. Tell us a little bit how you actually use machine learning. For maybe start out with what it is, just clarify, and then how you use it to come to better results.
Yeah. I mean, I think what we're really focused on at Unlimited is trying to understand the positioning of hedge funds at any point in time. And there's been let's call it the world of hedge fund replication, and actually the sort of academic theory around it goes back as far as Sharpe and his work on mutual fund performance and mutual fund alpha in the 90s, and then Andrew Lowe in the early 2000s. And a lot of that work was really based upon sort of prototypical regression approaches, right? So you look at the returns of assets over the course of a few-year time frame. You look at the returns of hedge funds over a few-year time frame, and you can sort of extract like what sort of asset returns are driving some of the hedge fund returns that you're seeing. And that really is good at sort of what I like to describe as extracting the beta, the asset return part of the hedge funds. But we all know that hedge funds move faster than like repositioning every 3 years. And so what's been interesting is there's been a real evolution, a real incredible set of evolution over the last 20 years from that sort of regression-based set of techniques that were sort of at the cutting edge to now being able to apply, much more sophisticated Bayesian strategies to figure out not just sort of a long-term sense of what hedge funds are exposed to, but a much shorter-term sense of what is driving the portfolio returns that we're seeing from these managers, which we get to see in pretty close to real time. And so those techniques or those strategies combined, frankly, with the computing power, computing power that today, like what we're doing today, like functionally couldn't have happened 5 years ago. It wouldn't have really worked economically. Puts us in a position.
Probably done it, but you would have spent so much time on.
Yeah, we would have. I don't know. We would have spent so much money trying to do it that it wouldn't have been worth it. Versus today, where we can run millions of simulations and things like that over a short time frame to be able to apply to our thinking. And so we're using those more modern techniques. I think the key thing to recognize, and this is a story true of all AI, machine learning, anything like that, is that you can't just load in a bunch of data, press a button and walk away, and it'll just tell you the answer to things. Particularly when you're thinking about financial markets, because the sample size in financial markets is just too small to have unguided machine learning or AI style infrastructure. Because, if you think about it, data over the last 50, 75, 100 years, it just is not that many data points that's available. And so one of the things that has to be done is to craft that approach with the experience. And, my co-founder, Bruce, and I, we've got 50 years of experience in the hedge fund business. Like I've run 2 and 20 money in the venture space. Like that is, that experience has to be paired with the techniques in order to build technology and build understanding that is sensible understanding, that is intuitive understanding of what's going on, rather than just sort of a garbage black box regression. And so, that's where I really see what we're doing is bringing together that experience, having built the proprietary strategies with the modern machine learning, put those two things together, and that will create a better outcome than just using the AI on its own.
Right, understood. Now, just for the audience, but also for me, when you say there aren't that many data points, I'm a little surprised, because I would think if you take a relatively long period of time, the question on how many data points am I willing to actually look at is mainly, if I understand it right, would be mainly driven by the time interval that you actually putting in, right? If you say, I want to look at every change in 1 second increments for all the times that the markets are open, plus 2 hours before and 2 hours after, for what, 75 years, I mean, that is probably a pretty substantial number by one entry. And if you have, I don't know how many, 5,000 entries or however many players you want to be looking at, that could get into quite substantial numbers. Now, I'm not saying 1 second increment is sensible, but I'm not quite sure why do you feel that there isn't enough data, or not that much data?
Well, I think what I'm contrasting to is, let's just say that you were, you know, I mean, like the classic sort of AI type things, you know, that existed were things like, I don't know, photos, right? It's like, okay, well, you can load 10 million photos of cats, right? Like, you know, or 100 millions of photos of cats. And that's, you know, you essentially have an infinite number of photos of cats to identify whether or not a cat is in the photo or not, right? And you're talking about orders of magnitude in the millions, hundreds of millions, billions of types of data or experiences. And then if you're talking about like a, you know, a large language model, you're talking about, you know, every piece of information that's been on the internet over the last, you know, 20 years, right? So those are big orders of magnitude. When you're thinking about financial markets, I hear you, you could look at every second. It's not clear that there's actually meaningful information in every second. The question is, where do you start to see meaningful information signal, right, relative to noise? And how do you understand that signal? How many data points are there in that context? And so as an example, when you think about hedge funds, we have some daily information, which has some information value. But if you had 20 years of daily information, that's only 6,000 data points, right? Like that's just not that big a deal.
Well, if you only look at the end score, so to speak, or value at the end of the day for whatever asset you're kind of analyzing, that yeah, you would be right. What I'm getting at, I have always understood, and please correct me if I'm wrong, because you're the expert and I'm only a novice in this, but for me, my understanding has always been there are two parts to this whole AI component, at least the way I understand it right now, and I mean AI, not AGI. The two parts I see is recognition, like you said, right? Enough pictures of cats, and sooner or later the thing can learn, even if it's kind of a fuzzy picture or just an outline, this is probably a cat, which satisfies that it can correctly identify something or recognize something. But then, and I think that's what we're also fascinated about when we do like GPT-4 or something like that, is now that it knows what is a cat or what is a letter or what is a sequence of letters that make a word or a sentence or whatever, now it can predict what is coming next, right? And so
and I think that's
and the prediction based on previous information. And that's why I said, if I'm thinking, you know, I'm looking at all the changes, I know this is maybe not relevant, but if I have 20 years, I do 1 second increment by 5,000 assets in like, for example, growth stocks, and I want to see, can this thing learn, for one, understand what is going up and what is going down, or buying and selling, properly recognize. But then the real power would be to say, okay, can I draw conclusions from the history that predict what's coming next?
Right. And I think that example is a good one, which is, let's just say we looked at the minute returns or the hourly returns of tech stocks over the last 20 years. Well, over the last 20 years, we've experienced, you know, multiple periods of the most extreme monetary stimulation that has existed in the modern world.
Right.
Okay, well, what if we went to a world where monetary stimulation was no longer that way? What if we went from a world where bond yields were low and stable to a world where bond yields were high and volatile, right? I think that's the sort of thing where, looking at a 20-year time frame, you know, even if you look at the minutes and the granularity, what you have is you don't have enough diversity of these macroeconomic, these big picture critical macroeconomic drivers to be able to start to actually create reliable inferences, particularly around regime shifting. And so it's why it has to be a guided tool. It can be used effectively by someone who is also sitting there saying, but bond yields might be volatile in the future, but, you know, but inflation may come in the future. I actually, you know, familiar with some products, some investment products that used AI that had, you know, in their testing sample didn't have any inflationary periods. And then all of a sudden inflation happens and it's totally unrecognized. Whereas if you're an investor and you look back over the last 100 years, inflation, of course, is considered part of your thing.
It's just, like it's human nature, right? If you have a programmer who's 25 years old and his whole lifetime never had inflation, wouldn't think about it, I guess,
That's why you have to put those two things together. You have to marry like the expertise with the techniques, and really the techniques and the AI. All it is they're just tools. They're tools that are no different than anything that has existed before, in the sense of they're just reasoning tools, and they have all the strengths of reasoning tools and benefits of them, but they also have all the challenges and the weaknesses of reasoning tools. And so, you put those two things together, you would not, just in the same way you wouldn't drive, follow the GPS off the cliff. Like, you can't follow the AI off the cliff.
Yeah,
in terms of what it's telling you.
Yeah, I'm totally with you. And I think in one way to put this for our audience a little bit in a box, so to speak, pun intended, is theoretically you could say, I have a human being that basically says I'm feeding the machine learning everything that has ever been there, the whole internet and the whole history since data existed, plus anything else that I can find. And normal people would say, well, but what, 90% of that is probably irrelevant to what you really want to find out what happens in this.
Or wrong. There's a lot of people who are out there who are like real futurists who are like, AI is going to totally radically change everything that we do. I think as someone who's been doing this for decades and has seen all sorts of different flavors of these things, what I'd say is like, it all comes down to prudent use by experts to ensure that high quality outcomes continue to exist, and that without that framing, right, in the same way mathematical techniques 20, 30, 40, 50 years ago needed that, the AI techniques need them today. It's just the nature in which you engage them is different. But in all of those circumstances, like what is sort of jokingly called hallucination with AI, like hallucination always existed with every technique that's ever existed. Hallucination just means it's spitting out something that's nonsensical, right? And it's inconsistent with reality. And so that's, from my perspective, having done this for decades, like that's how I look at it. As I said, great, another tool, has strengths, has weaknesses, needs to be appropriately guided, needs to be managed effectively, need to make sure it doesn't spit out stupid outcomes. Okay, well, how do you do that most effectively? And that's what we do.
Yeah, absolutely. I'm totally with you. Just a few days ago, I said in a different conversation when we also talked about AI, I believe, and I'm kind of adopting that into my vernacular, is I believe it's a little bit of a sad realization that we're using the term AI, or even the long version artificial intelligence. I think the state that we are currently in is more alike to high-speed probability software.
Yeah.
Right. And because that's, I believe, literally what it does. It got way faster. Like you said, it wasn't possible 10 years, at least not economically. So it got way faster, more capable. And the whole thing that it does in the old understanding, for anybody who was around when computers started to be something, is garbage in, garbage out. Right. So the probability accuracy is very dependent on, do I put good data in and enough of good data in or not? But for me, it's high-speed probability software versus, and I think the discussion that you hear, I hear, and other people, and sadly the media is constantly propagating, would be appropriately put in the corner or in the bucket of AGI, artificial general intelligence, that includes the G for real, true reasoning, not reasoning in the sense of dependent on formulas, but coming up with unique, new, innovative solutions that are not rule-based. Right? And I think we are probably, I don't know, some people say 5 years, other people say 10 to 15 years away from getting to that. It's basically, for me, or I've always felt, it's kind of, in a sense, how much and how close can we replicate the brain, at least. And we are at the point where we can basically keep the body alive, but we're not at the point to say, I have an idea on how to draw this new picture, a new kind of Mona Lisa, we're not there. We might get there, but I think that is a tragic thing that we already call something intelligent when it's really right now only following rule sets that smart people have programmed into it.
Yeah, I think that's a good point, and I think the question is always how, let's just say from a macroeconomist perspective, which is kind of how I look at things. I think it really comes down to productivity and to say what is the incremental productivity that we're gaining, from each one of these different steps, and how much better are things. And if anything, actually, if you look at what's going on, like in the U.S. economy, we're actually in a productivity depression. Right?
Yeah.
We've had it's the lowest productivity growth over the last cycle that we've seen basically in 150 years. And so I think that's the question are we starting to see limits of productivity growth, right? Are we hitting asymptotic limits of productivity growth? Like, I think that, the introduction of the personal computer was certainly an important step. Now, I think for people who sort of have a wider vision, like indoor plumbing was a lot bigger deal than the personal computer in terms of improving people's quality of life and improving productivity. But we're on that step. Then we got something in our pocket, and actually, like, is it better that I can scroll on, Twitter when I'm on the train versus, only at my desk? Like, not really is the reality. It's not making me that much more productive. I try and be as productive as I can on Twitter, but, it's not that much more productive. And so I think the question is, like, as an example, that these large language models start to develop. At this point, in a lot of ways, these things are just faster search, better calculation. How much does that incremental faster search than Google help you? Where does it help you? Really sort of struggling with and wrestling with what are the limits and benefits of the productivity enhancement from these techniques and these tools, I think is important. And I think when you do that, there's a lot of folks who will unrigorously promise the moon when we have a long history of seeing pretty modest benefit from incremental technology enhancement over the last 50 years. And so, that it could be a boom. It could add, 2% of GDP growth over the next 25 years. It could. That would be a pretty extraordinary outcome for a set of things that have not shown the ability to do that meaningfully yet.
Yeah, I'm absolutely with you, even though I'm a little bit more optimistic that might be because, like I said earlier, I only own 2 stocks and in a not equal balance and balance here. And the thing I'm kind of really glad that somebody introduced me to Tesla, even though I was late to the game, because it made me, I'm the kind of person who wants to study the things that I'm investing in or advise other people to consider investing in. And I'm more optimistic because this whole FSD or full self-driving thing that Tesla is developing, to me, is basically using artificial intelligence to have an object successfully survive in a very, very complex real life environment, not some simulation, not something, like I have a background in aviation. I'm a retired Air Force officer, and it is a huge difference when you're in a simulator and your brain knows if I do a mistake and the simulator, quote unquote, crashes, I can just hit the button and reset, right? Versus when I'm in the actual plane and I'm flying and I make a mistake and everybody's dead, not just me and the co-pilot, but also potentially a ton of people on the ground. So having a system, even though it's by no means finished, but having something, what is the most efficient process by doing it 23 hours a day. And when one figured out a slight improvement, all the others, they all look the same, like iRobot movie, part 2 or something like that. not in the outcome, but in the, like they all can basically immediately share what somebody learned. I can see unbelievable productivity gains, not at the high end of what we are in a knowledge economy doing these days, but on all the production end stuff where we're saying, okay, well, our aging population doesn't want to work hands-on in putting together cars or doing any kind of dangerous stuff or working in dangerous situations and stuff. And that is at the same time relatively, comparatively more trivial work than knowledge work. If we can replace that, imagine we could replace just that part of the economy with something that basically only takes some electricity and some computing power. I think it would be way more than 2%.
Well, I think a lot of folks predicted that we would be working 1 or 2 days, 1 or 2 day work weeks and enjoying our leisure time meaningfully. And thanks to massive productivity growth like 100 years ago, and it hasn't worked out that way. And so I hate to be the wet blanket, but
no, you're right. I mean, I'm not predicting that, or I'm not absolutely not sure that they're also going to really figure it out. But you said the profound, in my opinion, the profound and very correct thing. If there's any chance in hell that they're going to figure it out for all of us, that we only have 1 or 2 days a week, it requires unbelievable amounts of data.
Unbelievable. Yeah, that's and computing power, and you've got to work through that in a first class way to build an understanding that's guided. Because otherwise, without the guiding, you're going to find things that are problematic, let's say.
Yeah, exactly. Otherwise, the robot is going to say, I'd rather go out, pick flowers and do this shitty work. Now,
we'll definitely have to get back on together when we get our robots choosing to pick flowers.
Somehow guided it the wrong way or something. But one last point I want to definitely get into our show today is you guys also put a big emphasis on diversification, and I really want to have you kind of shine a little bit of a light on that aspect of what you guys do.
Yeah, well, I think one of the key things, having been in the investment space for a long time, is just recognizing that despite all the effort to make the best investment decisions that you can, you're going to be wrong, or things are going to happen that are outside of your control or unpredictable from your control. And so there's a lot of different ways that you can think about that problem. But from my perspective, diversification really is one of the most effective ways to protect yourself against a wide variety of outcomes. Now, part of that is, as a macro investor, I think it's important to recognize that macro investors, and you should every time you listen to a macro person say something about what's going to happen to stocks or bonds or whatever, you should keep this in mind. Like, the best macro investors are 55-45 on any one bet in any 1 month. And if you can be 55-45 on any one bet in any 1 month on one market or one stock or things like that, and you can bet that sort of weighted coin in your favor 100 times over and do that over the course of 30 years, well, that actually makes you the best, one of the best investors that has ever existed in history. But what that means is, but you have to go back and you have to say every time, what you're trying to do is get edge, right? Get a little bit of edge. But even the best edge is not that good. And it actually can be hard to tell in any one bet whether it was good, whether it was bad, whether you were right, whether you were wrong, et cetera. So I think macro in particular is beneficial because it's thing like that. And so, if people are interested in the overall thing, overall work that we're doing and our products, they should definitely check out unlimitedetfs.com, which gives more information about our various products that are out there.
Yeah, absolutely. And I think where people have a low barrier to entry, if they have the goal to continue build a relationship based on trust. Right? If I can come in with $100, not because I really seriously mean that I become a millionaire with $100 investments, but to say, okay, let me see how this works. Let me understand and learn what these guys are doing. Let me see some experiences, and then I can extrapolate to say, okay, this happened to my $100 here, my $100 there. If I were to put in something a little more meaningful, how likely is it that this will happen again? But you can get in there, even if you believe that that is the right way to go, and that would actually really further your intention to ultimately not have to work anymore, which is what Idea Wealth Grower is there, to help people to get to the Idea Wealth Grower time freedom point. Well, but if it's basically almost impossible to get in, versus low barrier of entry, building trust, and then keep doing it for however long it takes to be successful to the number that you want to reach. I think that is brilliant, and that is the way to go in the future.
That's exactly right. Making these things available to everyone. That's what's very exciting. Because we're all at different points on our path, right? And so in a lot of ways, I think that there's no good reason why people who are at different savings stages of their lives shouldn't have access to great opportunities and have access to the best opportunities.
Yeah, and I mean, there's another component, in human nature is called bragging. Right? If somebody does something that actually works, it's very hard to contain your urge to brag. And so the more they do, hey, I work with Bob at Unlimited, and I'm doing this. I started with $20, then 100, then 500. Now I'm at 10,000, and it works. At some point, they have to brag, right? And that brings you more people, and it's going to grow from there, I'm sure.
Exactly. That's what we're hoping for.
Okay, good. So with all that being said, and we put the email and the links to the website and stuff in the show notes, we reached the point where the two questions come in. So the first one you already know is, if you could meet anybody, who would it be and why?
Well, I think I'm a macro nerd at heart, and so probably at any point in time, I'd love to sit down with Chairman Powell, or maybe even if I could design it myself, a set of Powell and Yellen and Bernanke to get together to have a dinner where we discuss monetary policy and strategy and stuff like that. That's what I do. If they're listening to this podcast and they want to send me an invitation anytime, I will be there for them.
That's very good. Last question is, if you had a time machine, you could go anywhere, where would you go and why?
Oh, I don't know. That's a really interesting one. I think play on my macro policy nerd experience, and I'd probably book a room at Bretton Woods when they were designing the post-World War II monetary infrastructure. That was such a key to understanding how the world worked over the course of many decades following the Second World War. I think that would be a particularly interesting moment to the engagement about it. And we don't have a lot of basically none of those folks are around anymore. So it'd be pretty neat to see how they were functioning in that sort of closed door environment.
Yeah, absolutely. I think that's a good point. And maybe, you wouldn't, for a while, you change it maybe a little bit if you kind of whisper in somebody's ear that they need to write one sentence that the backing of the dollar by gold is not allowed to be removed. I think that would have saved us a lot of things. But anyways, if you go there, and if you happen to have the opportunity, that would
I'll gently suggest that.
There might be crazy presidents who want to take the dollar off the gold standard. That should be avoided. Okay, Bob, one last time, how can people get in touch with you?
Yeah. If you're interested in what we're doing at Unlimited, which we talked about, check out unlimitedetfs.com. Also, I write a pretty active Twitter about what's going on in macro. So if you are interested in sort of the blow by blow on a daily basis of all things macro, definitely check that out. I'm at Bob E. Unlimited.
Bob E. Unlimited. Wonderful. Bob, it was a great pleasure to talk to you and maybe discuss a little bit how things are going and why they're going that way. And I hope we can do it again sometime.
Yeah, for sure. Thanks so much for having me.
Thank you.